Well, futures in the red at the end of a very choppy week. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, Novo Nordisk plunging by the most on record after announcing disappointing drug data. Meanwhile, on the earnings fronts, FedEx delivers freight spin-off plans as Nike tries to get back in the race, and the House scrambles to avoid a government shutdown ahead of a midnight deadline. All of that and more coming up. Let's take a look at where markets are trading. Not too pretty. The S&P 500 down about 0.6% in the pre-market. We did see a little bit of a lift from session lows after we got that not as hot as expected PCE data at 8:30, but still in the red and then some, especially if you take a look at big tech with the Nasdaq 100 down by about 0.9% right now. Through yesterday's close, both of these indexes down 3% for the week, and it doesn't look like today's session will help. Then you take a look at the bond market, a little bit of relief there, at least at the long end of the curve. The 10-year Treasury yield now down between 6 and 7 basis points. We are back below 4.5%.
That danger zone, as we've been talking about. Dangerous indeed. A lot of red on that screen. Now, some stocks moving under the surface. Really interesting here. Eli Lilly is higher after competitor Novo Nordisk delivered results from its latest weight loss study that fell short of expectations. You see Eli Lilly rising about 6.7% pre-market. Also looking at FedEx jumping after the delivery company said it's spinning off its freight division. FedEx up more than 8.5%. Nike down more than 5%, falling after the sportswear giant outlined its turnaround plan to reignite growth. And investors are not chomping on the plan from that new CEO, Katie.
And we do have some breaking news, of course, all eyes on the Fed this week with that Fed rate cut decision. We know we got some dissents, and we got a dissent from Cleveland Fed President Beth Hammack. Now we have a statement from her writing about her dissent, saying that monetary policy will need to remain modestly restricted for some time. I prefer to hold policy steady until we see further evidence that inflation is resuming its path back to our 2% objective. So explaining part of the reason why she dissented, of course, she was the first dissent by a regional bank president this week since June 2022. And you'll remember, of course, that's when the Fed delivered the first of what would be actually 4 jumbo rate hikes.
What's incredible about this, too, is she's the newcomer on the committee here, and you did see her come over from Goldman Sachs. Michael McKee made this great point that she's seen for that reason as the market's voice. And here's what I think is a very operative statement that she has in here, is that she doesn't see, in her estimate, that monetary policy is far from a neutral stance. And that is one of the critical questions of this market right now, isn't it, Katie?
And as such, she would prefer to keep it in restrictive territory. A lot going on there. Of course, we'll break it down with Mike McKee a little bit later this hour. But we've got to get to the stock market, and we got to get back to our top stock story of the day, and that's Novo Nordisk. More than $100 billion of market cap has been wiped out since the Danish weight loss drug giant published new data this morning. So let's get straight to it with Sarah Scholin, our Denmark bureau chief, for the latest. And it was interesting. I mean, you take a look at some of the headlines that came out of this, and the numbers at first glance aren't too disappointing here. We're talking about an average of 20.4% weight loss over 68 weeks, but clearly that was below the 25% that many had been penciling in.
Exactly, and for the Novo share price, those 25% had really been priced in, and expectations were so high in the lead up to this. We've been waiting for this data all week, every single day, and now we finally get it, and it's a huge disappointment. So what we saw was the stock just started plummeting, and I can't help smile a little because it was just so crazy watching this. And at one point, the stock was down 29%, and it wiped out more than $120 billion of a market cap. And just to put that into comparison, for Denmark, it's a small country, it's about 1/4 of our annual GDP, just gone like that for a stock. So it's been a pretty wild day in Copenhagen.
Yeah, well, let's talk about that stock movement a little bit more, because Novo plunging by the most on record. I won't ask you if that's an overreaction, but what is stunning is that Novo has actually wiped out its year-to-date gains. It's now down by almost 14% on a year-to-date total return basis. Of course, you compare that to Eli Lilly, higher by 30% year-to-date through yesterday's close. I mean, the worry here, Sarah, seems to be that maybe Novo is losing its place as the dominant performer in this market.
Yeah, it was a first mover in the weight loss market when Wegovy first came out, and it really made a lot of money in that. Then Eli Lilly came in, and some recent data has showed that Eli Lilly might give better weight loss than the current drug from Novo Nordisk. So CagriSema was seen as this new drug in the pipeline. Is going to save them. It was going to make sure they stayed ahead of competition, and now we're not so sure it's going to do that anymore. And it just creates a lot of jitters.
So what comes next for Novo Nordisk? You have this idea that another trial in the first half of next year will help find out how patient doses can be boosted. But given the sell-off you're seeing in the reaction today, is that not fast enough? What near-term progress do they have to show investors that they're still in the game in a way that's competitive enough to really take control of the story once again?
Yeah, as you say, they're going to do a new trial of CagriSema. We're going to get some results later in that. So that's one of the main things. And what I hear from investors also in Denmark, they're buying up now. They're using this as an opportunity to buy the dip. Because regardless of how you look at this data, CagriSema will probably still be a blockbuster. So that means Novo Nordisk will make a lot of money. They will see their future earnings be really, really high. And higher than they were just like 2 or 3 years ago when they didn't have the weight loss treatments. So the prospects are not all that grim, but it's just adjusting to the new expectation out there. That really what's taking investors by surprise.
Yeah,
but what we do hear from a lot of analysts is that they are like this could be a buy the dip opportunity. But now we need to see the dust settle first.
Difficult show me story here. Denmark Bureau Chief Sarah Sjolund, we thank you so very much for all of your analysis. Of course, both Eli Lilly and Novo Nordisk moving difficultly on the news. Now, joining us now for the broader markets, Kristina Hooper, Invesco Chief Global Market Strategist. Want to go back to that hammock news because harping on neutral rate is unfortunately becoming one of my favorite things to do. I mean, has the market adjusted to the idea that not only are we higher for longer, but that there is a new reality that's underpinning the market here and what that neutral rate really is?
Well, Sonali, I'm in the camp that believes that a lot of discussion around the neutral rate and trying to pin it down is such an esoteric academic conversation that it's a moving target. And so I think it's wonderful to hear her views that we're close to neutral. I'm not convinced that's the case. Maybe I will be when I see more data, when I see productivity growth. I think there's a lot that would need to change my mind. I think there's a way to go for the Fed. That's my opinion.
Interesting. So, I mean, when you think about this dissent, and the fact that there was a dissent at all was interesting. If you were on the FOMC, would you have dissented? Where do you think the policy should be right now?
So actually, I agreed with a cut. I mean, I would have preferred to have waited until next year for another cut, give a little more time. But I'm of the camp that we should have, 4 to 5 cuts between December and the end of next year. So I would have waited a little bit. I think I would have preferred to cut in January. But she's on the other opposite end, saying she didn't want to cut in December and really isn't comfortable cutting again anytime soon. I think that we need to have more cuts because we're seeing disinflationary progress. Monetary policy is still restrictive. And I think that the dot plot showing just 2 cuts expected next year, I just don't put a lot of stock in it. I think we're ultimately going to see about 4 cuts next year, 3 to 4 cuts next year.
See, the reason this is a bold call, Kristina, is because a lot of people, notwithstanding today's data, are very worried about those inflationary pressures that could be brought on by potential policies by the president-elect. How concerned are you about those policies, and how would those change your view on that 4-cut view?
Well, I'm absolutely concerned. I'm actually more concerned about mass deportation in terms of its impact on inflation than I am about tariffs. Tariffs can be threatened, they can be quickly removed. Deportation is a much more significant, more permanent kind of situation. And of course, where we know a lot of inflationary pressures come from is the labor market. So if we have a tight labor market, especially in certain industries, that tightens further, that can be very problematic. But I believed Chair Powell in his November press conference when he said that the Fed wasn't going to guess, speculate, or assume about Trump administration policies because they didn't know the timing and they didn't know the scope. That's still the case today. We don't know the timing. We don't know the scope. So it's, I think, important not to anticipate anything and to wait and see how this unfolds and how it shows up in the data. Because, for example, tariffs could be in the short term inflationary, but longer term could actually be deflationary in terms of really softening demand, especially if we see 60% tariffs.
Right.
So I just don't want to jump the gun on this. This to me is a situation where we want to be data dependent. What the data is showing us, including today's PCE, is that we are on course. We're moving, perhaps slowly, towards target. But we know that disinflation is an imperfect process.
Right.
And that we can sort of have progress in one quarter and then a lack of progress in another. Recall first quarter of 2024, the Fed was very disappointed in a lack of progress and then was very encouraged by progress in the second quarter.
So there's a lot to dig into there. I'm glad you brought up mass deportation because Matt Miller, who's somewhere in Spain right now, he's been talking about this a lot, the effect that, you know, if you deport out a large part of the labor market, that what does that mean for inflationary pressures? But it sounds like what you're saying, all of these what ifs, that you're not ready to invest around them just yet, a wait and see sort of approach.
Absolutely. From my perspective, what we're seeing is a pretty orderly environment where the Fed is reacting to the data. We're seeing disinflationary progress continue. We're on track to get closer to the target. And I think we'll actually see an economic reacceleration next year. Markets are likely to discount that in advance. And of course, we have to take a step back and not just look at the U.S. The broader environment is one in which monetary policy is easing. And it will continue to ease because it is restrictive at current levels.
I want to take a look now because you have the S&P 500 down more than 3% on the week already, and you have futures down even more today. That is the worst week you're seeing since early September. If we look at the babies thrown out with the bathwater here, we're looking at sectors that were really sold off, and you have everything from real estate to energy materials. Almost every major group has sold off over the last 5 days. Kristina, do you see buying opportunities in that bunch?
Oh, absolutely. First of all, I should take a step back and say this is not surprising when we go back to 2016, right? We saw a strong rally coming out of the election. We saw very significant gains up until the peak on December 13th. And then we saw give back for the last few weeks in December of 2016. So I kind of anticipated that we'd probably see a pullback. Of course, it was incredibly exacerbated by that surprise dot plot. So where we find ourselves today is with certainly more bargains than we saw a few weeks ago. But I will say that if we look broadly, not only there are opportunities in the U.S. where valuations are a bit better, but if we were to look in small and mid caps, valuations are more attractive there. Cyclicals haven't really participated in a lot of the multi-year rally we've seen. And of course, if we go internationally, that's where we can really get some bargains.
All right, well, that is a 2025 conversation because we have to leave it there. Kristina, it's great to see you. Happy holidays. That is Kristina Hooper of Invesco. Let's go check on these futures because it is not too pretty right now. The S&P 500 down about 0.6%. The NASDAQ 100 down about 0.8%. Both of those indexes off by 3% for the week. The Russell 2000, your small caps, really in the hurt locker, of course. A lot of question marks over whether and by how much the Fed is going to bring rates down. That is a lot of cross currents for those small caps. The Russell 2000 down about 0.4%.
We'll see what the next week brings. It was supposed to be the last day that mattered. Then the days after still mattered. Stick with us because coming up next, we're going to talk about a stock that matters today. That's FedEx confirming a spinoff, why the company is separating its freight division within the next 18 months, and why investors like it oh so much. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. iPhone maker Foxconn is putting its interest in Nissan on hold while the Japanese automaker continues merger talks with Honda. Former Nissan chairman Carlos Ghosn tells Bloomberg what Nissan's potential merger with Honda means for the struggling automaker.
They have cash problem, they have investment problems, they're being really hammered in the United States. They got practically out of Europe. They're being challenged in China. and there is no plan in front of it. So I can tell you that means there is panic mode inside Nissan.
And over in the U.S., the U.S. has filed a murder charge against Luigi Mangione that could bring him the death penalty if he's found guilty. The federal criminal complaint against the suspect in the United Healthcare CEO killing includes 1 count of using a firearm to commit murder, along with 2 stalking counts and a firearms offense. And tensions are building between Amazon and the Teamsters Union. The union called on thousands of Amazon workers to walk off the job yesterday and is threatening more action just ahead of the holiday rush. In response, Amazon says it's filed unfair labor practice charges against the union, Katie, and I know we're going to stick on just this type of story.
Exactly. Staying on parcels here, we're taking a look at shares of FedEx soaring pre-market. That's after it said last night that it plans to spin off its freight division into a separate publicly traded company within the next 18 months. Joining us now for more is Lee Klaskow of Bloomberg Intelligence. And Lee, this was expected to some extent. We know that FedEx in June said that it was reviewing specifically the freight business, but clearly investors happy about this actual announcement now that we have it. Why does it make sense to separate here?
Yeah, so I think there was a lot of expectations that during this quarter they were going to announce whether they're going to spin or not spin. I think, why it makes the most sense is that they're really able to unlock a significant amount of value, less than truckload carriers, which FedEx Freight is, and it's also the largest one in North America. It tends to trade at a higher multiple than the parcel industry. It tends to be higher margin business. And it has a lot going for it over the long term. It's a market, like I mentioned, it's pretty consolidated. It's continuing to consolidate, and they have significant, or maybe not significant, but very good pricing power, which tends to be, a really good long-term story for these LTL carriers. Kind of nearer term, they are facing some demand headwinds, which we saw in the quarter. Demand was slightly below expectations. And that's really driven by the industrial economy. The LTL business is really more geared or leveraged towards the industrial economy, to roughly 75% industrial manufacturing and 25% retail. That retail and consumer part is growing, but that is what's really been driving it. And IP and industrial production is expected to accelerate next year, but again, near term, the headwinds as related to ISM, because ISM is a pretty good indicator for LTL demand. It's been a contraction territory for 24 of the last 25 months.
It's interesting because the enterprise value that you see from this business to be spun off could be as much as $33 billion, according to your analysis. I don't know that a lot of investors realize just how big this business was. For new investors who might want to buy into that business, what's the growth rate? Because is there a rationale to buy it in an IPO or to have even a financial strategic buyer come into this?
Right. We don't do buy wholesale recommendations at BI, but we don't think a strategic buyer is going to be coming in. Because you're not going to have one of its peers buy it, because it is, like I mentioned earlier, the largest LTL carrier in North America. There could be, some issues with 2 of those large players merging. We thought that if anyone would come in, it could be like a Maersk that is looking to maybe further diversify their business, because they want to always get deeper into supply chains. And the North America market is a very attractive market as it relates to the trucking industry. So, in our view, we thought the most likely outcome was going to be a spin. Secondarily, maybe a large player, like I mentioned earlier, like a Maersk or a DSV in Europe, could be interested. But we didn't think a financial player would come in because, FedEx has pretty good margins. They're not industry leading. That's Old Dominion. There's roughly around 800 basis points of delta between their margins or operating margins. But Old Dominion network is a little unique. But FedEx does have the opportunity to close that gap. Maybe not get it as low, but they definitely could close the gap. But that might not be too compelling for a financial buyer.
All right, Lee, keep in touch, of course. A fascinating story here. That is Lee Klaskow of Bloomberg Intelligence talking about the FedEx spin-off news. FedEx shares of about 8.5% pre-market as we look ahead to a new era for FedEx. But we do want to bring you some breaking news now, and that is on Carnival reporting earnings. Fourth quarter adjusted EPS beating estimates, more than double, or rather double expectations, 14 cents versus a loss per share of 7 cents. So interesting there. You can see that shares up about 3.7% pre-market. You also had revenue come in at $4.94 billion. That was also ahead of estimates. Good news for a stock that's already flying year to date, up about 36% on a total return basis. And we'll be speaking with Carnival CEO Josh Weinstein coming up at 2 p.m. New York time later today. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. We're minutes away from what looks to be a pretty hairy opening when you take a look at the major indexes right now. The S&P 500 down about 0.5% pre-market. We saw a little bit of a bid at some point yesterday. That obviously faded. So we're looking at another down day. We're down 3% this week, one of the worst weeks of the year. Then you take a look at big tech, and it's not too much better. The Nasdaq 100 actually down about 0.7% right now. The small caps also struggling. The Russell 2000 off by about 0.4%. Stick with us through the open. A lot of single stock moves to sort through. We'll bring it to you all live. This is Bloomberg. Oh, just kidding. We have a minute. What is this?
I know, a minute to the opening bell. But a lot is moving before the market. I mean, the one thing I was looking at in addition to the market moving, Katie, was the market pricing, because fascinating, the bond market really was the tail wagging the dog this time around, wasn't it?
Absolutely. It's interesting, though, to see the bond market actually get a little bit of relief today. Yields are actually lower, but these high levels that we're at, that danger zone that we've been talking about at about 4.5%, it doesn't seem to be providing any relief to the stock market right now.
I wonder if you need a new danger zone, because you have Torsten Slok this week coming out saying there's a 40% chance that the Fed hikes next year, not cuts. You have the market pressing in less than 2 cuts into the end of next year, and the moods are changing quickly, Katie.
Okay, now I promise we're going to break. The opening bell is up next. Don't go anywhere. This is Bloomberg. All right, we are moments away from the start of trading on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and it looks like the final trading week of 2024, the final full trading week, is going to be an ugly one. You take a look at where futures are right now, seconds before the bell. It's red across the board, of course. That traces back to Wednesday, when we finally heard from Jerome Powell in his final meeting. Now you have the bulls in this market seeing dots. And it'll be interesting to see how that trade develops in 2025. But at least in the final days of 2024, sentiment has absolutely collapsed. But in any case, you do see the bells, and you hear the bells ringing right now over at the New York Stock Exchange and at the Nasdaq right now. Just about 18 seconds into the trade, let's take a look at where we opened up right now. The S&P 500 down about 0.5%. That brings us to about 3.5% lower on the week. One of the worst weeks of the year, and I can say the same for the Nasdaq 100, currently off by about 0.8% at this moment. The small caps, this has been where a lot of the pain has been felt most directly. The Russell 2000 down about 1% right now. Of course, this is your loss leader on the week as those small companies grapple under the potential of higher for longer. Meanwhile, let's take a look under the hood, though, because we do have some good news, and that is Eli Lilly. It's jumping, but that's after its competitor Novo Nordisk delivered results from its latest weight loss study that fell short of expectations. You have Novo dropping by the most on record, with investors betting that Eli Lilly catching up to the first mover in the weight loss drug market. Sonali.
I'm keeping an eye here on another mover. On the upside, we're looking at FedEx here. It's looking at a gain of more than 5% right now as the market opens. It said that it's spinning off its freight division into a separate publicly traded company, one that Bloomberg Intelligence believes could be with an enterprise value of as much as $33 billion. Nothing to cry home about. Let's flip up the board, look at Nike, because that is lower. The new CEO, Elliott Hill, made a big earnings debut, but he said his turnaround efforts may hurt earnings in the short term, and you have Nike down just about 1.5%. We're going to take a closer look at Nike with Poonam Goyal of Bloomberg Intelligence, and I think back to our conversation yesterday, and what we were grappling with was the recognition that you had made that we were not going to get a full plan. Stock is down, not by all that much, all things considered, but how high is the bar now for him to move faster to get that turnaround story on the table?
I think the turnaround story will still take time. As he alluded on the call, the back half of Nike's fiscal year will be challenging with the fourth fiscal quarter even more challenging than the third, where they see a low double-digit sales decline. So I think we're looking at fiscal 2026 at best to see signs of better sales and momentum actually picking up, which means the back half of next year is probably the earliest when we'll start to see some positive news from Nike.
And Hill did address that on the call. You think about, what's on his to-do list right now. And he said, quote, "I recognize that some of these actions will have a negative impact on our near-term results, but we're taking the long-term view here." You're not seeing that long-term view being expressed in the stock right now, Poonam, but it sounds like you do have confidence in the long-term vision.
Absolutely. I think he's doing the right stuff. I mean, in order to get any company back to where it was, you need to clean house. And that is what they're doing right now. They're getting rid of aged inventory, which is going to cause margins to drop and sales to drop as price drops. So that is much needed before they can actually move forward. It's the playbook of any turnaround story. You have to cut out the fat to actually get moving forward.
Well, it'll be fascinating to check in on Nike this time next year, because for this year, year-to-date, shares down 28%. Poonam Goyal of Bloomberg Intelligence. Have a great weekend. Let's broaden out this conversation now with Louis Navellier. He is Navellier Associates Chairman and Chief Investment Officer, joining us on set on this Friday morning. Great to see you.
It's great to be here.
Let's talk about the Fed, because you take a look at that dot plot that spooked everyone, that expectation that the Fed will only cut by twice 50 basis points in total next year. It really sent ripple effects through every single market. Did it surprise you?
No, they can only see so far, but they'll probably cut rates 4 times next year because we expect interest rates to collapse in Europe. Bloomberg did a survey that said the rate should be 2% by June. Some economists have it at 1.75. So we got 4 to 5 more rate cuts from the ECB because Europe's in a horrific recession. They're also leaderless right now, at least France and Germany are. And so as those rates come down, it should drag our treasury yields lower. And of course, we have an incredibly strong dollar, and the treasuries are supported by all this international buying pressure. So I do expect 4 cuts next year.
Why do you believe that with inflation where it is right now? What do you tell people who are still concerned about it heading into the next year, and then maybe even more concerned about it when you think of some of the potential policies that you might see from the president-elect?
Okay, so we had a very good PCE this morning, okay, better than expected. And if you back out owner's equivalent rent, shelter costs, we're already at 2%, okay? So the Fed hit their mission, and the only problem is something about Manhattan real rents and rents in Baltimore. Everywhere else, prices are being cut. I mean, I flew up from Florida. Trust me, prices are soft there now. So, eventually owner's equivalent rent's going to come down, okay? And then we'll be just like Europe. I mean, they don't have rental inflation over there because they're losing households. And that's the one big thing people have to realize. The rest of the world is shrinking. China lost, 2.08 million people last year. Europe's shrinking. At least in America, we're growing. We have household formation, we assimilate our immigrants, and we're the economic engine of the world.
It's a good point, too, on PCE, of course. Not as hot as expected, and I wonder how different the conversation would be had we gotten that number 2 days before the Fed instead of 2 days after. But talk to us about how that translates through to the long end of the Treasury curve. You mentioned, rates coming down. Are you ready to add to long end duration here? Because that's broken a lot of hearts in 2024.
Well, I'm not the bond guy. I'm my own bond expert. But I will say this. I think the reason the yield curve was so inverted for so long is Janet Yellen could not manage the long end of the curve. A couple years ago, she had some disastrous Treasury auctions. The bid-to-cover ratio got out of control. And so she just kept selling more short and intermediate debt, which everybody was happy to take. Now, Scott, our new Treasury Secretary, is coming in, and that'll be his job to manage that.
It's interesting because we think about the run over to the S&P 500. Going into this morning, you had just mentioned that the S&P 500's reaction to the Fed release here was fairly choppy, but you look at the year, it's still a good year. You're looking at the S&P 500 still up more than 20%, but what strikes me is the divergence. You have stocks like Vistria up 252%, Nvidia up 160%. On the other hand, you have Intel and Walgreens each down more than 60%. If you had a market that was up more than 20% in a year as choppy as this one, how do you treat the laggards? Can they be forgiven at a time where so many tides
No,
have
they
risen?
can't. This is, other than financials, this is not a sector market. And, NVIDIA is my largest holding. And, but yeah, AMD and Intel score very poorly in our system. They're Ds and Fs. We grade stocks A, B, C, D, F. Vistra is also one of our big winners. If there is a theme out there, we got to double the power grid. Now that Trump's coming in, they can do that with natural gas. And so that's going to be very exciting. And because, normal search is like 2% of our power grid, but AI search is at least 4%.
Right.
So as the AI gets faster and faster, we're just going to be using a lot more electricity. So that I have several companies that are building out the utility grid. And green energy works, but you have to have a transmission line called a DC grid, and they don't have the grids for that. So if we get serious about green energy, maybe we can put in some better grids. Maybe Musk will tell Trump to do that.
Perhaps a lot of big question marks heading into next year. But I actually want to talk a little bit more about that point you made that this isn't, aside from financials, a sector market. Can you expand a little bit more on that? We were having a conversation with Jean Bovin at the start of this week talking about how don't look at this as an asset class market. Look at this as a narrative and a story-driven market. And it sounds like you might be saying something similar.
Yeah, my whole thing is all my research is online free. I launched a book with Wiley in 2007 to launch our stock grader. We have an encore book coming out. But basically, we like to paint a picture of the market's very fickle, and we always test our models. And right now, they're decaying at a very orderly rate. I will add that the breadth and power got slightly better, but it's still, everybody wants the winner. I mean, I know everyone wants to talk about the Magnificent Seven. I like to talk about NVIDIA and 499 other stocks. So, it's everybody just wants to latch on to the winner, and look at what happened to Musk recently, how his net worth went up.
That's true.
Louis, we have to leave it there. We wish we could have you for longer, but come back with us in 2025. We're going to want your top picks for the new year. That is Louis Navellier and Associates Chairman and Founder. Now, coming up, we're going to talk politics because Donald Trump's party had voted against them in this instance. The president-elect had his first big test of lawmaker loyalty. We're going to talk about the budget dispute. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on stocks about 13 minutes into the session. Still down, but a little bit better than where we were at the open. The S&P 500 now off by about 0.2% right now. We had been looking at losses of 0.5%, so a little bit better. The NASDAQ 100 also clawing back here, still down about 0.5%. Then you take a look at the small caps. The Russell 2000 making a run for it, currently higher by about 0.1%. We'll see if that holds. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, BMO is downgrading drug makers today, including Merck, amid mounting skepticism across the pharma industry. The analyst says that Merck is no longer a buy and that shares could be stuck in limbo over the next year. Next up, Citi says that French fry maker Lamb Weston no longer a buy, downgrading the company to neutral. Remember, Lamb Weston reported a second quarter earnings miss, cut its guidance for next year, and announced that its CEO was leaving, so a real triple whammy there. And the analyst also says that the company's recovery will take longer than expected and be limited by price competition. And finally, we have Morgan Stanley upgrading the owner of Chili's, saying that it's no longer a sell. Brinker's international strong turnaround appears to have legs, according to the analysts, and recent data suggests that the company is performing well. Shares up about 1.3%. Meanwhile, let's turn to politics because the Republican-led House voted down the plan backed by President-elect Donald Trump. The rejection sets the stage for a potential U.S. government shutdown, with funding set to lapse at midnight. Joining us now from Washington is Bloomberg's Mike Shepard to help make sense of it all. Tell us about the 38 Republican lawmakers who voted against this, Mike.
Well, this is a signal, Katie, that not everyone is going to fall into line automatically with Donald Trump on what he says on his legislative priorities. And these include the debt limit. He called for eliminating the debt limit as part of what he would see an acceptable version of this temporary spending bill. Now, the debt ceiling is seen by a number of conservative fiscal hawk Republicans in Congress as, let's say, a guardrail against excesses in spending by Congress, by the federal government, and they don't like seeing it raised, let alone eliminated without much thought. And so, therefore, we saw last night 38 Republicans join Democrats in opposing this bill. And with the margins in the House and also the Senate not favoring Republicans, this bill failed. And now they are scrambling. They are back to the drawing board. It's unclear even whether they have a plan C. Plan B failed last night, and whether they'll have support for it in time to get a vote before midnight, which is when funding expires.
I do want to ask more about the vote itself, but when you think about the posturing between the House Republicans and the president-elect, I do feel compelled, Mike, to ask you about what this means for other large issues down the road, say nominations. Does it mean that there could set up for larger fights in Washington heading into next year after the inauguration?
That's a great question, Sonali. And actually, one of the reasons Donald Trump would like to see the debt ceiling handled now rather than during the coming year, he wants Congress to be able to focus on his policy priorities. And those include the border and tax cuts. And he wants those done as soon as possible, even within the first 100 days of his administration, which is a symbolic achievement. But it's also something that would gain momentum for his agenda. If Congress also has to deal with the debt limit, which snaps back into place, by the way, on January 1st, that would really slow things down. Let's turn the clock back. In June 2023, you and I both will remember just how messy that was and how it shook financial markets. We came within 3 days of a historic default the last time around, the last time Congress had to debate the debt limit. So basically, Trump is trying to clear the decks for his agenda, but it is not going to be as easy as he thinks, in part because the party margins in Congress are so narrow. He doesn't have nearly the mandate that he is trying to suggest or trying to project on social media and elsewhere, even before he takes office.
So a lot of big, impossible to answer, at least for right now, questions when it comes to next year. But let's talk about January 3rd, and let's talk about the speaker vote, because Mike Johnson, I would imagine he would like to keep his job. It feels like he only just took over, of course, October 2023. What does it look like for his political future?
This is a really tough question to answer, only because it is so fluid at the moment. And his caucus is not seeing a lot of reason for confidence in him. Just last week, he was at the Army-Navy game in the presidential box with President-elect Donald Trump, watching the game, signaling some sort of proximity to the president-elect and the incoming administration. And yet, just a matter of days later, Donald Trump, joined by one of his closest advisors, the world's richest man, Elon Musk, just barged into these budget negotiations that have taken weeks and disrupted and upended legislation that Johnson himself had led the negotiations on and really was steering toward a vote to avoid the kind of drama that we're in right now. So all of this does not bode well necessarily for Johnson. We heard Ralph Norman the other day on Bloomberg television telling us that, hey, this is not a great moment for Johnson, and this is something that is cause for concern among Republicans who would have to vote on whether he should return as Speaker starting next year in the next Congress.
Certainly the GOP grappling with what it means to have more cooks in the kitchen. Bloomberg's Mike Shepard in D.C. We can't take our eyes off it. Thank you so very much for all of your reporting. Now, coming up, dissent at the Fed. More on why the Cleveland Fed president voted against the Fed's latest rate cut. That's next in our Wall Street Beat. This is Bloomberg.
My projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
That was San Francisco Fed President Mary Daly speaking earlier, and it's time now for the Wall Street Beat. Cleveland Fed President Beth Hammack writing about her dissent from the Fed's latest decision to cut rates, saying the following: a stall in inflation above 2% for too long would risk de-anchoring inflation expectations, making it harder to return inflation to our objective. Joining us now, Michael McKee, Bloomberg's chief economics and policy correspondent. When you think about what Beth Hammack is saying here, and first of all, her kind of dissent is adding a lot of excitement to the Fed in an already exciting year, isn't it? But how does it pair with what you're seeing in other data about where inflation expectations are heading?
Well, it's kind of ironic because she pointed out today that we'd seen inflation stall, and she does not want to see to be cutting rates until she sees progress on inflation going back down again, which a half hour before her statement came out, we did see with the PCE numbers coming in lower than expected. Now, the question is that going to continue? CPI was obviously not great last time, and so she has a position. We'll see if it continues and if other people join with her in it. It's interesting. You look at the dot plot. I think we have that here for 2024, the one that just came out, and it shows, if you look at the upper left-hand side, you can't really see it very well there, but basically what it shows is there were 4 people, one of whom presumably was Hammack, who thought they should not cut rates.
Yeah.
So she's not alone, and that means we're going to have probably more disagreements as we go forward into the coming year.
Well, that's what I wanted to talk about, because this was the first dissent by a regional bank president since June 2022. And it felt like for a while the Fed was really unified, really sort of voting in lockstep. Now you're starting to see some drama. And as someone who roots for chaos, should we be expecting more of these, not only dissents, but public dissents?
Well, if you consider what we've got, chaos, then you'll probably be happy in 2025.
All
because
right.
we're going to have a lot of we're already starting to see the speeches and commentary come out after this last meeting. We'll see more of that once the year begins, as we get closer to the next meeting, and you'll see people taking different positions. The question is going to be who's going to be the center of it all, and I would watch for, obviously, if we hear something from Jay Powell, John Williams, who was on CNBC today, basically saying he's undecided, and then somebody like Chris Waller, if he speaks, watch those more than the others, because if they are for a rate cut or for a pause, that's probably what the committee will do.
Now, I believe she said also that in her estimation that we're getting closer and closer to that neutral rate. What did you make of that commentary in the dissent?
Well, she said that before the meeting when she made a speech and suggested we're getting close to a pause. The problem is nobody knows what the neutral rate is. The estimates are between 2.5% and 4%. So she's obviously on the 4% end. We're at 4.25 now on the low end. So we don't have very much farther to go. And that would suggest one rate cut. But others think, John Williams thinks it could be as low as 2.5%. So we could see, and with that debate, no resolution, and that gives them reason to keep cutting if they think it goes farther.
All right, a lot to look forward to in 2025 on the Fed Watch front. That is Bloomberg's Mike McKee. Have a great weekend when you get there. Meanwhile, let's take a check on the stocks right now. Of course, 25 minutes into the session, you can see we're still lower on the day, but not as low as we were pre-market. The S&P 500 down by about 0.3%. Big tech leading the way lower, currently off by about 0.5%. The small caps making a run for it, up about 0.3%. We'll keep our eyes on the Russell 2000. Now, coming up in our next hour, we'll be joined by Jim Rowley. He is the CEO of Crunch Fitness. He's joining us to talk about New Year's resolutions. Don't go anywhere. This is Bloomberg. We are 30 minutes into this trading day on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, Novo Nordisk plunging the most on record after patients using the experimental obesity shot lost less weight than predicted in a study. And if obesity drugs don't work out for you, there's always the gym. We're going to speak with Crunch Fitness CEO Jim Rowley, and the House scrambles to avoid a government shutdown ahead of a midnight deadline, Katie.
And before we get there, let's get a check on these markets right now. 30 minutes into this Friday on the final full trading week of 2024. The S&P 500 down about 0.3%. As we've been saying, better than where we were pre-market, but still for this week, the S&P 500 off by more than 3%. One of the worst weeks of 2024. I can say the same for the NASDAQ 100. Your big tech names also off by about 0.5%. The bond market actually catching a bit today. We had better than expected PCE data out at 8:30. That's bringing some relief to the bond market. Yields down 4 basis points, but we're at very elevated levels here, above 4.5%, Sonali.
And it's crazy. All the data is good today, Katie. We have Michigan final December consumer sentiment data rising to 74. The estimate was 74.2, so just about in line, maybe a little soft. But still, after that PCE data, things look pretty smooth. And joining us now is Nicole Inui. She's HSBC head of equity strategy for the Americas. You take the economic story we're seeing, the data, but then you take that drip of concern that you're seeing one after another. You take Beth Hammack over at the Cleveland Fed, worried about inflation. Jay Powell himself mentioning the inflation word and sparking some concern. How do you pair that concern with the general exuberance you've seen in the market, notwithstanding this week's sell-off?
Great. Thank you. Thank you for having me on. So one of the things we focused on for next year when thinking about our target is really the behavior inflation will be important. Thinking about next year and thinking about what the Fed is going to do. At the end of the day, we've reduced the amount of rate cuts that we expect for next year. So now we expect 325 basis points of cuts for next year. So that's a little bit more than the market's expecting. But if we get less, we always are looking at why are we getting less rate cuts? And if we're getting less rate cuts because the economy looks resilient, it's still going strong, that's actually good for equities. Because at the end of the day, we're looking at nominal GDP growth to really understand where earnings growth is going to go next year. So I'd rather see fewer rate cuts because we have a stronger economy next year, rather than more rate cuts because the economy is weakening or the labor market is weakening, which we do not expect.
It's a great point. Of course, context matters for the justifications behind what the Fed will actually do. But talk to me about the situation where we get fewer rate cuts than maybe we thought we were going to get a week ago, because that's part of the reason why that dot plot, why we're seeing small caps really fall out of bed on a weekly basis. I mean, you think about different areas of the market, where needs more rate cuts right now?
Yeah. So I think, again, we're expecting fewer rate cuts. Let's say if we get even less than, what the market's expecting, or maybe no rate cuts next year, we're in this environment of higher rates for longer for next year. And thinking about sector positioning, looking at the consumer, and this is why we're less positive on the consumer sector, on consumer discretionary and consumer staples. That's really going to be a headwind for the consumer for next year. We've talked a lot about this K-shaped consumer, where the high-end consumer continues to do well, even though you have higher rates, and the lower-end consumer obviously is feeling more of this pinch from this higher rate environment. So if we go into next year, continuing with this idea that rates are going to stay higher for longer, we think that kind of K-shaped consumer continues to play out for next year. And, add that on the risk for tariffs and so forth. So overall, in a sector positioning on a relative basis, we're less positive on consumer discretionary and consumer staples, given the fact that maybe we get less rate cuts than expected for next year.
Nicole, I also want to talk about indices for a moment here, because they say a lot about the sectors that investors are looking to. And if you were talking to me, if we were talking together at the middle of the year, the Philadelphia Semiconductor Index would have just been roaring. And if you look now, it's actually trailing the S&P 500. You have obviously seen some AI names just run away. That has not been an even trade by any means. What does this mean about how you think about sectors and indexes moving forward? Do you go away or into the semiconductor index based on what we've seen already?
Well, what we've been talking about, and I think since the Fed started easing for the past couple of months, is to start looking at broadening your exposure beyond tech, beyond Mag 7. We continue to say Mag 7 is an important part of the index. This group of stocks represents about a quarter of earnings for next year. So it's important that these stocks continue to grow and continue to do well. But what we've been talking about is really starting to look at other sectors, especially when we look at EPS growth for next year. You're going to see this broadening. So you're going to see healthcare that's going to grow around 20%. You're going to see industrials that's going to grow at a fast pace as well. And really starting to catch up a little bit to the tech sector, which we still continue to grow at a faster pace and grow at a robust pace. But, at the end of the day, we need to see this movement into other sectors, this pickup in growth that we're going to see in other sectors that will kind of bring a healthier equity rally into next year. So if you're looking at EPS growth for next year, you take out Mag 7, you're going to see probably a double-digit earnings growth for these Mag 7 X tech stocks. So that's why we're recommending to broaden into these other sectors.
Well, Nicole, we're all saying the word sector a lot, and I find that interesting because we were just having a conversation with Louis Navellier at the opening bell, and he was saying that this isn't a sector market other than financials. You really can't break apart the market into sectors. You have to get a little bit deeper than that. And I wonder if you agree with that sort of argument, or how specific do you need to be right now?
No, I think that's a good point. I think, one of the things that we were looking at, obviously the big pushback we get is valuations, and valuations are definitely stretched. And again, it's not just tech, it's just not just Mag 7, but you're seeing it across sectors as well. But when we talk about sectors, and I think what you're saying in terms of just talking about the sector, you're looking at a sector, consumer staples, that's trading at a very high, certain companies are trading at a very high PE. And the sector as a whole, just a couple companies really represented kind of the growth or that performance of the sector in 2024. So really you need to go into each sector and kind of go downstream. So you're going to need to look at these companies. There's the high valuation, high ROE, high profit margin companies, but there's still a lot of quality companies that if you look downstream are trading at reasonable valuations, more discount valuations compared to these, I'd say, these big companies that we're seeing in certain sectors. And that's where we're seeing opportunities to expand into next year, especially with this pushback that valuations are very stretched at current levels.
So if you think about broadening as well, I feel like this has been an increasingly painful question. And Kitty, I think you know what I'm going to ask about here is that small cap, mid cap trade. We've heard many people say to us now that, okay, fine, yes, small cap, mid cap, maybe better reflected in the S&P 600 or a different index that would give you more profitability perhaps. How do you feel about those trades, especially relative to the other forms of broadening that you're seeing?
We're getting a lot of questions about the small cap space, and again, I think this points back to this pushback you get on valuations. So if you look at the valuations for the companies for the small caps, it's at a huge discount to what you're seeing on the S&P. But our argument has always been that you see that discount for a reason. So when you look at where ROEs are, you look at where profit margins are for these, for the S&P, for these companies, these large cap companies. It's widened to what we've seen in the past. So you're still seeing this huge gap in terms of profitability when you look at the large cap compared to the small cap. And again, if we're going into this environment where rates are higher for longer, where we're going to get fewer rate cuts for next year, the companies in the small cap space, they're more highly leveraged and more exposed to this floating rate debt. So they're not going to get as much of the relief as I think the market was initially expecting if we had gotten much more rate cuts for 2025.
Nicole, we've got to leave it there. We'll see you in 2025. Have a happy holiday season. That is Nicole Inui of HSBC. Meanwhile, let's going to take a look at these stocks moving this hour because there are a lot of single stock stories to pay attention to. And we start with Eli Lilly and Novo Nordisk. We got really interesting data out of Novo this morning. Its experimental obesity shot, CagriSema, it helped patients lose an average of 20.4% of their weight over 68 weeks. But Novo had been teasing a 25% weight loss target, and you can see the disappointment in shares down by the most on record. It's good news for their competitor Eli Lilly, and you can see that that moving higher by about 5% at this moment. But also on the earnings front, we have to talk about FedEx. The news coming last night that it plans to spin off its freight division into a separate publicly traded company within the next 18 months. They had teased the possibility back in June. They said that they were reviewing the freight business. They still have issues, of course, with their core businesses, but you wouldn't necessarily know taking a look at the stock. It was popping pre-market. Now some of that enthusiasm fading a little bit, currently down about 1.2%. And we have to end with Nike because Nike shares falling. That's after its new CEO, Elliott Hill. He warned that his turnaround efforts may hurt earnings in the short term. He pledged to reignite growth by refocusing on sports, revamping the company's products. Poonam Goyal over at Bloomberg Intelligence told us to focus on the long term, but I wouldn't say the traders are doing that right now. Shares down about 1.6%.
Yeah, you got to give something to show for the long term first. But, you know, speaking of workout shoes, this next guest is going to make me feel bad about my performance this week because I didn't make it there. Crunch Fitness, of course, the gym. The CEO, Jim Rowley, shares his projections for 2025 and the potential sale of his business. We're going to talk about working out next. This is Bloomberg.
New year, new you. Saving money and improving physical health are the top two New Year's resolutions for Americans in 2025. That's at least according to a YouGov poll. Enter Crunch Fitness, which pitches itself as an affordable gym chain. But Crunch could face new ownership soon because TPG is weighing a sale of Crunch for up to $1.5 billion. According to Reuters. Let's get into all of it now with CEO Jim Rowley. And Jim, we'll get, of course, to TPG questions, but I do want to talk about the new year and what it means for Crunch, because we talk about seasonality, cyclicality in other industries all the time. How dramatic is that effect when it comes to the fitness industry?
It's dramatic. It's as dramatic as everybody publishes. But to be honest, what most smart people are doing is they're joining in December. They're getting a head start on it. They know they might overindulge in the holidays and so forth. So we see a big spike in membership sales in the last 5 days of the month.
Humor me here, because so many people make those promises for January 1st. How long do you find people sticking with it?
Well, the Crunch average member is about 2.5 years, but those that don't join just for the resolution, it's probably about 100 days. And we encourage them because we say, look, it takes 21 days to make a habit or to break a habit. So go for 21 workouts before you make your decision if it's resolution based.
And I want to talk about GLP-1s. We've talked to you about this before. Obviously, GLP-1s definitely in the news this morning with Novo out with some recent trial data. But talk to us about the evolution of the impact of these weight loss drugs on your industry, because I remember, especially about a year ago, there was this big concern that people would stop going to the gym. At least anecdotally, it feels like that narrative has cooled off a little bit. But what are you seeing from where you sit in the industry?
Yeah, this has been one of our biggest sales years in the history of the company. And I'm not saying it's because of the semaglutides and GLP-1s, but what we are seeing is we're seeing a little bit more practicality associated with it, where it's micro dosing instead of taking the mega doses that we saw and heard about, and it was all the celebrities were doing, and we saw Ozempic face and everything like this. We're seeing micro dosing, which is still suppressing your appetite, allowing you to get in the gym, build the muscle. You have to have that muscle as part of your fat burning machine as well. So we're really encouraged by kind of where the two worlds are meeting, and our trainers are prepared and ready to meet you on your journey.
So, Jim, I want to go back a little bit here. We talked about the sale rumors that are permeating around Crunch. I want to go back to your history because you're no stranger to private equity. In 2009, you had helped initially earlier, you had led 24-Hour Fitness. You teamed up with the private equity arm of Angela Gordon to buy Crunch Fitness out of bankruptcy. You've done this before. You've seen this story. If you think about 2025, what's the goal here? What would be the rationale for an exit? And would going public even be or part of that story?
Yeah, it's always funny because when you meet that 5-year horizon with your private equity partner, all the rumors start swirling around. We've had significant success. We're the #1 fitness franchise in the world, according to Entrepreneur. We leased more space, according to several real estate software groups. Franchise Times has us as #1 fitness franchise. It's been 5.5 years with TPG, so now all the speculation comes up that we're going to do something in 2025. I guarantee you, we will let you know. I think your show is amazing. I get up for it. You guys are excited about fitness, so if something happens, we'll let you know. But hey, stranger things have happened, right?
Well, we appreciate the kind words, and we love having you on as well. And speculation aside, I do want to try to make a little bit of news here. So, I mean, just broadly speaking, if you take a look into your future, could you see a future where Crunch is a public company?
I think it's a really interesting conversation to have. If you look at the success of Planet Fitness, I think their market cap's at $8.5 billion right now, and kind of where they were when they went public and so forth. I don't know if it's a big aspiration for me personally. I like being a private company. I like the flexibility that comes with that versus the public demand. And even today, you're talking about a semaglutide company that was aiming at 25%, they got 20%, and now the stock is coming down and so forth. That's a lot of scrutiny on a business, but it is interesting. I mean, it is interesting.
Speaking of interesting things, you know, last time we had you on, we were talking about kind of the pains in the broader gym industry, whether you're acquiring some assets, whether you would be. And, you know, one rationale to go public would be to have that currency to buy other assets. Do you think that that's something that you would want to do, public or not public?
Now, you guys are digging in this morning. Great question. Yes, it's always something that we're interested in. We just saw what happened with Blink Fitness, and that we're going to be announcing actually a small acquisition that will be announced in the next week or so. But our franchise owners are very active with respect to this, and you continue to see a lot of concentration on the mid-markets, and that's creating a lot of opportunity for acquisition in the industry.
Well, we appreciate you rolling with us, and we'll keep our eyes out next week for that news. But I do want to talk about pricing. We focus on the consumer very heavily on this show, and the consumer, it's been hard to pin down exactly the pulse there because, you know, one industry, you're still seeing gangbusters growth, and then maybe another, it's a totally different picture. How are you thinking through pricing, and what are you seeing from where you sit?
So, obviously, one of our competitors, you know, raised their base pricing this year, and they're touting the great success and so forth with it. We've maintained our $9.99 price point as a marketed price point to allow members who maybe have financial concerns, but also have the great desire to work out, to feel better, to just get stronger, all of these things. So we've appreciated that pricing is part of running a business, but we also have an integrity issue here where we owe it to the consumer to offer something at a high value and a low price. So we've maintained level price consistency there. We do small increases every year with the active member base and so forth. But it's the duality of doing the right thing, having more people attracted to your business, and increasing revenue, right? So that's part of the CEO's job, is to make those decisions.
Jim, in the commercial break, we were all kind of just talking about our favorite workouts. I've learned that Katie's the muscle and I'm the gentle flower of this show.
I don't know, I'm doing Pilates, so it's not exactly powerlifting.
What is your workout goal for 2025? What do you like to do?
So I'm still a weightlifter, but I do Pilates, as I told you earlier. So it's really that combination of finding the balance of strength. I went to Hawaii in June. I was 245 pounds. This morning, I'm 223.
Wow.
So I've dropped a lot of weight over the summer, and you never know what's going to happen in 2025, but I need to get in my fighting shape for what may happen.
So we both do Pilates. I have a feeling you have bigger biceps than me, but, you know, it's great to see you, Jim, and we got to get you on the Pilates train as well. It's great.
2025 goal. I will join you. We'll talk about it on the show. We will drive Matt Miller crazy.
There you go. Jim, have a great holiday season. We'll see you in 2025. That is Crunch Fitness CEO Jim Rowley. Now, still ahead, Starbucks workers set to strike in 3 major cities across the U.S. We'll bring you the details next. This is Bloomberg. right, it's time now for Social Climbers, the companies making waves this morning. And first up, workers at Starbucks stores plan to go on a 5-day strike starting today to protest lack of progress in contract negotiations with the coffee giant. The strikes are set to start in Los Angeles, Seattle, and Chicago and could spread to hundreds of stores by Christmas Eve. The strikes come a day after Amazon was also hit by a walkout in the crucial final shopping days of the season. Next up, U.S. Steel is reporting its fourth quarter earnings will fall significantly short of consensus as steel prices remain depressed. Analysts say that the results are worse than expected and underscore why a deal with Nippon Steel would be beneficial. And finally, there's a new menu item coming to Taco Bell, chicken nuggets. The fast food chain is trying to appeal to younger consumers who prefer poultry over beef. Taco Bell did acknowledge the challenges of a crowded chicken market in a written statement saying, quote, nugget loyalty runs deep. Though their words, not mine. The chicken nuggets, though, they will be available while supplies last. Meanwhile, let's get a check on these markets right now because we do have a turnaround on our hands. The S&P 500 now higher by 0.2%. Maybe Santa is real and that Santa Claus rally is starting to kick in because the NASDAQ 100 also underwater for the week, now up a little bit. We're talking about small moves overall, but of course the direction of travel to the right and higher right now. And then you take a look at the bond market, a similar story, of course, crawling our way out of a deep hole, but 10-year yields currently down by about 4 basis points. Still elevated, though, when we take a look at levels, Sonali, right in that danger zone of 4.5% on your 10-year Treasury yield.
You know, usually I'm stuck on the 10-year, but right now I'm still stuck on Taco Bell. I was just thinking it was time for a Crunchwrap Supreme. Doesn't really fit with my gym membership, though. Anyways, coming up, office real estate may be facing a year of reckoning in 2025. We're going to discuss that with Liz Hart. She is Newmark's president of Leasing for North America. This is Bloomberg. The Biden administration is drafting plans to allow the construction of data centers and power plants on federal land. This is as more companies buy more real estate and team up with nuclear plants to power their AI products. Joining us now, Liz Hart, Newmark's president of Leasing for North America. She last joined us to discuss the data center real estate boom that we've been seeing. And one big question is that energy infrastructure around it. When I talk to people who are looking to buy into new data centers, that energy story is one of the biggest questions. You've asked a great question the other day of our guest, which is how much are communities getting frustrated with this? Do they encourage it more, or do they say, well, this needs to happen in order to use that real estate properly?
Well, I think it's a mix of a couple different things you said. So first of all, 25% of the industrial sales that we tracked last year actually were going towards data centers. So there is a lot of that industrial infrastructure that's moving that direction. As for communities, you did see cities like Atlanta passing legislation that said, get the data centers out of where the housing is supposed to be, put it somewhere else. And I do think 2025 is a story of mixed use, redefinition of the urban core, and that's not really the right place for data centers, right? There's other locations for it. What's really encouraging, though, is there's a lot of innovation around how we can get power to those sites and get it there more efficiently. And I think we will see that happening because when there's a need, you know, innovation occurs to make it happen.
Well, talk to us a little bit more about the urban core and the traditional office space, because it's hard to get a read. We talk to some people who tell us, you know, the fears are overblown. Other people are still saying, actually, we like commercial, but we still don't want to touch office. What is the mood music from where you're sitting?
Well, I think both things are true at the same time, and that's why you're hearing both. On the trophy side, it's been an incredibly great year. Large renewals from, you know, companies in New York like Wilkie, Bain in Boston, Airbnb in San Francisco, going into great product, and we think that that will continue through next year. So Trophy, incredibly optimistic around that. Actually, you probably don't know this, obviously, but 60% of the buildings across the United States are actually 90% occupied or more. So that part of the market is completely fine. Now, on the other side, there definitely are buildings that are facing debt maturities next year. And even with this rate cut that we just saw, you know, they're still going to have a hard time at that maturity. So they need demand to come back into those buildings to start to price it and move the market forward in 2025.
Well, I want to get into that, but I do want to ask what a trophy is. What makes a trophy office building?
Well, I mean, traditionally, it would be in the best area. So taking New York, Park Avenue, that's certainly trophy, 7% vacancy or less. High-rise security, amenities. I think another good example would be the Spiral. The Spiral had HSBC move into their building earlier in the year, and their utilization went from 40 to 80% when they went into the trophies.
Wow.
So can you imagine, if you're all of a sudden on a flexible work schedule, you went from 40 to 80%, that makes it worth the investment, right, to get into those better products. Now, with that said, I think a big opportunity in 25 and beyond are those buildings that are not quite trophy yet, but have the opportunity to reposition themselves. And we're seeing more and more landlords make investments to do so through the amenitization of their basically ground plane and adding more to get people to get back in the office in a meaningful way.
I think that the credit reporter inside of me really wants to ask you about the tough stuff, the things that are on the brink of distress. Because if you think about that demand picture that you were just talking about, then what needs to happen to increase that demand? Is it a matter of pricing? Is it a matter of kind of rehabilitation of these office buildings? How do you get there?
I mean, I think demand is mostly driven by business growth, right? So we do think the Trump administration will be good for business growth overall, and we're seeing growth across all sectors. For the demand that we're tracking, our tenant demand, 40% are new requirements that just started in the last 6 months. That number is higher than usual. So you're seeing more and more new requirements hit the market. So we're feeling pretty good about what 25 will look like. Now, the trick, though, is you can't just look for space. You actually have to transact on it. But what's great is in the third quarter of last year, we saw 30 of the 60 markets go into positive absorption for the first time since before the pandemic. And we're pretty optimistic that we'll see that again in the fourth quarter and beyond. So we think the bottom has behind us, and now it's time to go up.
I do want to talk a little bit more about political influences in 2025. We talk a lot about Elon Musk and Doge. What effect do you see that possibly having on your business when you think about government leases, for example?
Well, the government, when you take it collectively, is the largest tenant in the United States. So certainly one to watch. And what's interesting about government leases is they typically do have termination options in them. So that's something to watch very closely because they do have more flexibility than most tenants do. With that said, that's a constant in our market. That's been like this for as long as I've been in the business, forever. What's interesting, too, about the government is, like many big users, they kind of did a little kick the can down the road during the pandemic, lots of short-term extensions. So there is, a larger portion that will be coming to lease, where you get to do a new decision in 2025 to 29 than we see during typical administrations.
It's interesting. I'm going to ask you a question that seems a little dated these days. But do you think that when we look at these trophy buildings that people are going to say, I want people in them, that they're going to require people to be in office, living near cities, being there 5 days a week and potentially working harder as, if you expect that this is going to be a pro-business environment, people are going to want to get back to work?
I agree with you. I think productivity is going to be something to watch next year, especially with the changes in AI, right? Never has it been a more difficult time to navigate the challenges that are ahead of us from artificial intelligence, just changes to the business environment. And I believe the business leaders we're talking to mostly want people back in the office to navigate that environment and build their businesses.
All right, Liz, it's great to see you. Have a happy holiday season, and we'll see you in 2025 soon, I hope. That is Liz Hart of the Newmark Group. Now, we do want to get back to one of our top stories of the day, and that is Novo Nordisk. Shares absolutely plummeting right now, down 20% intraday. That is its worst drop on record, and that's after a study showed that people treated with its experimental obesity shot, CagriSema, lost less weight than the company had repeatedly predicted. Meanwhile, on the other side of the trade, you take a look at Eli Lilly and other obesity drug makers gaining on that plunge. Eli Lilly in particular up about 4% right now. Viking Therapeutics up even more. Let's break it all down now with Emily Field. She is head of European pharmaceutical research over at Barclays. She has an overweight recommendation on Novo Nordisk. And I just want to start with your reaction because, of course, you take a look at the reaction in the stock market. It has been brutal right now. Is this an overreaction?
Yeah, and thanks for having me. We're saying yes, it does seem to be an overreaction, but I do understand why investors are, not happy with this data because exactly to your point, 25% weight loss, 25% weight loss. That's what the company's been saying for years. And it came in at 23%. So, and we don't have full information and context as to what necessarily drove that miss. We will find that out in the weeks ahead. But I think that a lot of this really just comes down to credibility and missing the bar that they'd set.
So missing the bar, Then how do they turn that credibility story around from here? What do you want to hear from them, especially if you think that this was an overreaction?
Yeah, importantly, what we need to find out, and we'll find out as more of the data is published in the coming weeks and months, is did they miss that bar because of the way the trial was designed? One thing that they told us, I spoke to the company this morning, was that only 57% of patients got to the maximum dose of CagriSema. You tend to lose the most weight when you're in the maximum dose. So did they miss that bar because patients were just kind of happy with the weight they lost and didn't go to the max dose? Which would be a good thing, meaning that they probably could have gotten there had everyone gotten to that dose. Or did they not get to that dose because of side effects? We just don't know the answer to that question today. So I think people are just, kind of taking a negative view today.
I want to talk about positioning here because I think it's really stunning that you take a look at Novo versus Eli Lilly year to date. Novo shares with today's loss, of course, are now negative for the year, down 13%. But really, they've been having a tough time since the middle of the year. Then you take a look at Eli Lilly, and it's higher by 36% on a total return basis. And I think this chart really speaks to how fiercely competitive this industry is. Is Novo still the leader when you take a look at the field?
I mean, we've been thinking of this obesity market as really being a duopoly across these two companies, and that they'll probably, split market share for all intents and purposes in the years ahead and be far ahead of competitors. But, and I think this dovetails into why Novo's reacting the way it is today. Lilly just published a study a couple of weeks ago showing that Zepbound, you lose more weight than Wegovy. We know that. That's been replicated in Lilly's own study. And so CagriSema was supposed to be better than Zepbound. The data presented today makes it look kind of the same. So we're not able to draw definitive conclusions today. Is CagriSema going to be better than Zepbound, or is it going to be just as good? It's still way better than Wegovy, but there's just still so much information that we need.
I'm also curious, given the disappointment that we're seeing today and the reaction, how sensitive is your price target at this juncture? What would cause you to change it, potentially to the downside?
Well, I mean, of course, we have to evaluate, all of the available information. But I think that one thing, and this is why we're defending the stock, is, CagriSema is not going to impact 2025 earnings. It's really important for beyond that. But I think today, looking at valuation, the stock's trading at 21 times next year's earnings, which is, a far greater, lower multiple than it's traded at in recent years. And, we're expecting 20% top line growth for next year. So we think that the obesity story for them is still fully intact, and that CagriSema still will be a phenomenal drug. It's just that, it just didn't hit this bar. So I think we're just all still trying to process that, to be honest.
Let's talk about another potential silver lining here. Again, you're not seeing any silver linings in the stock price this morning, down 20.5%. But side effects. CagriSema had a safe and well-tolerated profile in the trial, and most common adverse events were gastrointestinal. I thought that was interesting because, the side effects for not just Novo, but for Eli Lilly's drugs as well, that had been an intense topic of conversation. But it feels like the temperature has come down a little bit there.
Yeah, and in speaking to the company, they said they felt very comfortable with the side effect profile, and there was nothing in the press release to indicate that there were a far greater number of side effects with CagriSema than with semaglutide Wegovy alone. We'll find out the details to that when the data is presented, but I do think that was one of the positive components of the press release.
Emily, we thank you so much for joining us today. We really appreciate all of your analysis, of course, on a big day over at Novo Nordisk. That is Emily Field, head of European Pharmaceutical Research at Barclays. Now coming up, a story about trade-offs. Former European Union Commissioner Margrethe Vestager discusses regulating technology companies for the region. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And how does a country curb companies from dominating an industry without stifling innovation? Bloomberg's Max Ramsey spoke with former European Union Competition Commissioner Margrethe Vestager about the EU's self-assigned role as the world's regulator-in-chief.
One criticism has been that Brussels' aggressive approach to regulation, especially with big technology companies, has held corporate Europe back versus its global rivals. The person at the center of this policy for the past decade is Margrethe Vestager, the EU's former competition commissioner. We spoke to her on her final day as the bloc's top antitrust enforcer.
What that has been sort of my drive in Danish politics, in European politics, was to make sure that everybody has a fair chance of making it. And making sure that the market provides for that the market serves customers, that has been, the trend of these 10 years for me.
It's a mantra that has resulted in some of the toughest rules in the world for big tech. Another way to put it, if you can't beat Silicon Valley at its own game, regulate it. Vestia has overseen some of the EU's most high-profile cases, taking on the world's biggest companies and issuing over 25 billion euros in fines for abuses of dominance and cartel violations.
Today is a big win.
She won a record 13 billion euro tax judgment against Apple and oversaw one of the EU's landmark pieces of regulation, the Digital Markets Act. We asked about her rise from Danish politician to perhaps the most feared name in Silicon Valley.
I don't really know how to prepare for being on the front page of one of the US main papers. It's important to figure out how to go with it.
Fair is fair.
I came, of course, from executive positions in Denmark. I was the deputy prime minister. I had several experiences as a minister. But I think the most important point is that you believe in what you do. That's the cases that we have fought, that they have been fought with great work by the teams with very strong evidence. I think that's the kind of preparedness that you need, that you believe that this is a strong case and you have something valuable to say.
And from her point of view, things have gotten better.
I definitely think that we have made progress. The world was different 10 years ago. How we looked at technology was very different 10 years ago. Nobody was really asking questions to say, is this really fair? Is this a good way to behave in the marketplace? That has changed completely. Now people have much more nuanced views. I think seeing all the good things that comes with technology, but also realizing that we really need to take care, both to make sure that the market remains open, but also that technology is not addictive, is not providing rabbit holes or dark patterns or anything else that may manipulate us as humans in ways that undermine how society works.
But today, Vestia's legacy faces a challenge from those who say regulation has hurt Europe, stopping it from creating massive technology companies to rival the US or China.
And that was Margrethe Vestager talking to Bloomberg's Max Ramsey. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, the record-breaking year for the ETF industry comes with an asterisk. Despite record inflows and launches, as we've been discussing on this show, funds are actually shuttering at a nearly unprecedented pace. Let's break it all down with Bloomberg cross-asset reporter Emily Griffeo. We just published on this theme this morning, and it's been interesting. We've been talking about this all year, that you have all of these new funds coming to market. It's easier than ever to launch an ETF, but actually achieving success seems to be an increasingly tall hurdle.
Yeah, that's what Bloomberg Intelligence told us. And we've kind of been thinking about this theme all year. As the space is getting more competitive, it means that the shelf space at a lot of these platforms that financial advisors and institutional investors tap into to actually select their funds, the shelf space is getting thinner. And so it's harder and harder to kind of compete here and get your fund to market. But there are some exceptions to this. Leveraged funds have been very successful this year. So if you can kind of come to market with a niche product, even if you're a small issuer, you can still find success. I feel like that's what this year has showed us.
We can totally talk about success, but as Katie knows, both of us have been looking for drama all day. And
rooting for chaos. So
let's talk about disaster. What's not working?
So what's not working is the smaller funds that are just launching, funds that are similar to what the BlackRocks, State Streets, and Vanguards of the world are already, they already offer. We also saw a number of closures in the ESG space, international stocks, and also ETFs that had to do with China. Those were kind of the big themes for closures and shutting down.
I also thought it was interesting. I mean, we had a conversation with Amrita Nandakumar. She's president of an ETF sub-advisor called Vidant Asset Management. And she made the point that, in your first year, a new issuer, they should budget at minimum $250,000 in working capital. That's without spending a dollar on marketing. And it's interesting, even though that seems pretty low overall.
Peanuts for BlackRock.
Exactly. But a lot of these smaller issuers who are coming to market just can't cover their costs.
There's been such a proliferation of white label issuers, which means that there's been a proliferation of startup entrepreneurs who want to launch ETFs. They don't need, to be a BlackRock to come to market. But they do need a good idea that's going to work. And like you said, they do need a certain threshold of assets and a certain amount of volume in their ETF to scale the ETF. So I think there's this perception that, just anyone can launch an ETF. And what this year is showing us is that that's not exactly true.
You know what's interesting to me as well, and I think we talk about this a lot with you in the vein of active ETFs, but if you see some of these types of ETFs going out of vogue, ESG is a good example, does it change the traditional thinking around ETFs where it used to be set it and forget it, buy an index and let it fly? Is it now much more active because certain things just will not be popular anymore?
Well, I mean, at least again, what's finding success is the super leveraged ETFs, the single stock bets, micro strategy, 2X, and what's closing is again, what's kind of boring. And it was interesting this year, the stock market did so well, and we still saw a near record amount of closures. So that's really, typically if the market is doing well, you should be able to kind of have a fund that's
remember when ESG
successful.
was the hot term of the year?
Oh my gosh, do I remember. And it always seemed to be issuer-led, enthusiasm among the companies that were launching the ETFs rather than investor-led. You do make an interesting point about set it and forget it, and you marry it together with those super leveraged ETFs that are launching. If you're invested in double leveraged MicroStrategy ETF, you need to watch that because the volatility drag will really hurt you over time. But bring us into 2025. What is the expectation there? Because this dynamic has existed for a while. Do people think that it will sustain next year as well?
It's so not what Jack Bogle would want to see, but unfortunately, it might be a trend that we continue to see as people keep most of their portfolios in the low-cost passive funds. They have that little slice that they can now allocate to crypto, to leverage, to pair trading ETFs. So unfortunately, that dynamic might continue, unfortunately for Jack Bogle.
All right, Emily Grafeo, great to speak with you. That, of course, is Bloomberg's Emily Grafeo. She covers ETFs with me over on our cross-asset team. And be sure to tune into ETF IQ every Monday in the new year at 12 p.m. Eastern. And you can read all about the ETF industry if you subscribe to my weekly newsletter. That is Bloomberg.com/ETF IQ. And Sonali, it's our last show of the year.
It's so sad.
It
was a down week.
Quickly. I know. Apparently, we have a little bit of green on the screen, of course. I feel like the market makers realize it's our last open interest of the year. We launched the show in July. It's been a trip, and looking forward to 2025. But before we get there, let's take a look at these markets. Quite a turnaround underway. You look at the NASDAQ 100 up about 0.9%. The S&P 500 also there as well. Of course, that's not enough to dig us out of the hole that we're in, down by more than 2% on the S&P 500, on the NASDAQ 100, but putting in a fight on the last full trading week of the year.
We wanted the drama. The drama came. It's still in the market, the last show of the year. And it's interesting because the moment we started this show, would you think the 10-year would be at 4.5%?
I did not. The bond market has been the epicenter of volatility for all asset classes. That certainly is the case today as well. A little bit of relief coming into the bond market, not exactly helping stocks out in the pre-market, but a turnaround. We'll see if it holds through 4 p.m., but that does it for us. This was Open Interest, and this is Bloomberg.